So the global rise in yields has been one of the larger stories over the last few weeks. So we thought we would spend a little bit of time here talking about it. So one of our favorite phrases from one of the more interesting guys in U.S. politics over the last couple of decades comes from James Carville. And it's someone we have talked about before and referenced this quote before. So in the mid-90s, he was working in the Clinton administration, and he said, he used to believe if there was reincarnation, I would want to come back as the president or the Pope or maybe a 400 baseball hitter. But now I've decided I want to come back as the bond market because you can intimidate everybody. And so great turn of phrase as usual for him, but he's really referencing what was happening in the rates markets in the mid-90s, which if you go back and look was a pretty volatile time. And really investors were voting with their feet. They were seeing persistent deficits in the US and rising debt levels, and they basically said, we'll finance you, but it's going to cost you. And so, that administration started to make some changes, and it resulted in a few years of a balanced budget, a few years of surplus, and then we've kind of gone back from there to our normal pattern that we've seen the last couple decades of persistent deficits. So we're headed back to that similar time, and it appears that investors are having the same conclusion now. Persistent deficits. We're seeing the total federal debt approach or eclipse $40 trillion. That's up from $20 trillion just 10 years ago. So kind of a rapidly changing pace, and some may consider it to be unsustainable, to be honest. And eventually the bond markets get a hold of this and say, again, we'll finance you, but it's going to cost you. So it's beginning to get real for the U.S. budget, which has now seen the cost of kind of servicing debt go up pretty dramatically, starting to crowd out other spending. So it will be interesting to see as we head into midterms and a presidential cycle in 2 years, does that get politicians' attention because it's going to start to force some hard decisions. So we'll lay that aside for a second. It's definitely for the future, and we'll come back to it if we see some ideas. But the chart we'll put up here just gives you a sense of what it looks like around the world. So on the left, you have the U.S., in the middle of three large European countries, and on the right, Japan. And so in blue is the yield changes of the 2, 10, and 30-year debt in each of these countries since the beginning of the year. And you see some pretty significant increases. The white bar is the change since the end of June. And so maybe I'll focus on the two ends, the left end and the right end. The middle's a similar pattern in Europe. But if we start here on the left with the U.S., you see large increases in short rates year to date, but more increases in longer rates since the end of June. And again, that points to maybe some concern over inflation, but a little bit more attention to that whole fiscal situation that we're dealing with. Out on the right-hand side for Japan, a little bit different. Larger increases in long rates year to date, but short rates up more since June. And that, again, kind of depends on the path that the Bank of Japan is following. Different here than the Federal Reserve, which has largely been on pause the whole year. So it's interesting to see some of these things come about. What does this mean for investors? If you're a total return bond investor, it's been kind of a ho-hum year. So these increase in rates have largely eaten up the income for the year, and you're largely flat, maybe a percent higher or maybe slightly down, but not a material change there. If you're kind of a buy and hold income-oriented investor, honestly, you're fine, right? You're still getting paid your yield, defaults notwithstanding. So if we're talking about governments, certainly you're fine there, particularly in these 5 markets. And then as yields lift, you have that maturity and you roll that out on the long end, you're getting a little bit more yield as you go along. So depends on your perspective, but certainly a challenging market to figure out what investors really want from each of these countries based on the plans that each has in their government and in their spending. So worth watching, and these political cycles that we see over the next couple of years will be very interesting to watch what is done as some harder choices have to be made in the way that we spend money kind of federally, if you will. So with that, thank you for stopping by. I hope you have a great day.